Hello and welcome everyone. I'm Vernon Cushenberry back with another quarterly update, and we had a great quarter. Returns were good. I want to give you the bottom line up front. Nothing that I see this quarter causes me to believe that there's any deviation from a well-laid financial plan that is likely to happen for all of our investors in our retirement plans. That typically means that your target date fund is the correct course for all of our clients and our wealth management initiative. Hopefully you've had an opportunity to meet with your financial planner in the last 6 to 12 months. If not, make sure you get a meeting scheduled and let's update those plans. But should be, I want to spend a few minutes giving you an overview of the market, and then I've cherry picked a couple of slides that I think are timely that I want to take a deeper dive into. As you can see, everything was green last year, and markets have looked good over the last 5-10 years. I always try to take a 30,000-foot view and make sure that I subtly redirect investors' attention to what does matter. And what does matter is that over time, markets have consistently compounded capital for patient investors. And we want to make sure that we revisit those timeless truths on a quarterly basis so we can capture these turns. One of the most detrimental forces in finance is that return chasing behavior that investors fall prey to so often. With just a little bit of perspective, we can cut that off at the pass. You can see a longer term view of the markets here. A little bit of volatility in the short run, as always, but had a very nice year. 10-year Treasury right now currently sits at 3.9. The dividend yield on the S&P 500 at 1.5. Let's look at valuations real quick. Every quarter I do a check-in on valuations, and the price to earnings ratio that you can see on this slide here currently about a little over 19.5. That puts it on the high side of what we consider to be a historical reasonable range. So we need to see earnings catch up to that in the next year. That's what we'll be looking for, paying very close attention to. If I rewind a year, all of the Wall Street pundits were worried about a year where inflation could potentially get out of hand. There was a lot of talk about a quote unquote hard landing, meaning that they were looking for the next recession around the corner. And lo and behold, none of that came to pass. The Federal Reserve did a very deft job of managing those interest rates, and the markets were up 25%. And this year, all of the Wall Street pundits seem to be like-minded in that we are targeting a quote-unquote soft landing, which would imply that we might sidestep a recession. Will we be able to do that? I don't know. I just thought it was worthy of pointing out that the pundits, they don't always know what they're talking about. As a matter of fact, if you look at their track record, I'd say that they rarely know what they're talking about. This business of predicting the future is a challenging business. But so this quarter, we are entering into an election year. So I thought I'd just take a look for some of our investors who have asked the question. Typically, markets do a little bit better in election years, but I want to make sure that I frame that properly. And what I mean by that is if you flip a coin 10 times and 7 times it comes up heads, does that mean that the next time you flip, you have a higher likelihood of flipping heads? No, absolutely not. So when we look back at the history of elections, well, you can see here we have 10 or 12 of the last 100 years to analyze. That's not a statistically meaningful sample. So if we identify that 7 out of those 12 times the market has gone up more than average, well, is that meaningful? Maybe. We don't have enough data to say that it's statistically significant. Nevertheless, you can see here that over past administrations, the market has typically done well in Republican administrations, typically done well in Democratic presidential administrations, and the market does what the market does. Capitalism moves on. If we analyze only the investment year, what you can see here is that the average returns subsequent to an election, so the year after an election, have been 10.67% if we look at the S&P 500. If you look at the average return during an election year, that's 11.57%. So not quite a full percentage point higher. Again, is that statistically significant? Absolutely not. But you do see this media cycle and this incentive, especially by incumbent administrations, to try to stimulate the economy during election years. The economy is always a hot button issue, and it would stand to reason that some of those initiatives would leak into the market at large. So I share that for what it's worth. I did notice this quarter as I was sifting through a mountain of economic data that as we look at stocks and differentiate those growth versus value, value is looking more and more and more attractive. I just mentioned that looking at the market through the lens of presidential elections or election years is not statistically significant. What is statistically significant? Well, value. There's a variety of indicators in the market that have proven out over time with enough observations to be meaningful. We can put that through the scientific method. We can test it. We can use that to determine the likelihood of returns persisting into the future. So what do we know has worked over time? Well, what do we know has worked over time is that small stocks have a tendency to outperform large stocks. Everybody wants to buy Microsoft in 1982 or Berkshire Hathaway in 1968 or Tesla in 2017. If I give you a list of small cap stocks today, good luck picking out the next Facebook. But if ever so tactically at the margins, you tilt your portfolios towards smaller stocks or towards cheaper stocks or towards higher quality stocks, those factors have been shown to outperform over time. Not every year. It's a bumpy ride, as is everything else in the market. But we can see here on this slide that value stocks are, they're getting cheap again, as they have a tendency to do when interest rates rise. So that's a pocket of inefficiency, and pockets of inefficiency in the market represent opportunity. So we take note of that. And this is something that will influence our investing behavior on behalf of our clients. So I wanted to share that with you this quarter. And I also wanted to share another slide that jumped out at me as I was pouring through this data, which is top right here, the percentage of unprofitable companies in the Russell 2000. When interest rates are cheap, you see hot money pour into sectors that they may be unprofitable. Oftentimes, those are growth in nature. Investors historically have been willing to fund initiatives that could pay off in the future. Those are oftentimes unprofitable companies today, and maybe those companies become profitable in the future. But we've seen this number steadily rise over the last decade, this percentage of unprofitable companies. And to me, that is an indicator that investors have steadily and increasingly become more and more aggressive with their investment selection in the marketplace. So that's just a little bit of a pink flag, light pink flag. Maybe I pay attention to it as I do all of this data on a quarterly basis and try to share some of it with you every 3 months. And I always end these videos by circling back to some little bit of timeless wisdom. And I cherry picked this slide for the quarter. It shows the returns to the equity markets in light green, the returns to the fixed income market in gray, and then the returns to a balanced 60-40 portfolio in the darker green. Last year, we were hearing a lot of questioning about whether or not the 60-40 portfolio might be dead. Last year was very unusual. We had a rising interest rate environment, which is detrimental for fixed income returns. We saw a lot of our bond market investments decline during that year, the correlation amongst varying asset classes that are typically used to dampen that volatility inside of your portfolio was as high as we've seen it in years. So that is course correcting somewhat, and we've seen the returns to 60-40 portfolios bounce back significantly in 2023, up 18%. That's more conventional. That's more in line with what we expect from a 60-40 portfolio. You can see that it's really the exception to the rule that balanced portfolio would decline over time. And moving forward, we expect our investors to benefit from a higher interest rate environment and for those correlations to return to normal. So keep that in mind. And as always, hit me up with any questions. I'm here as a resource. I'll be back with more economic data and another market update in 3 months. Thanks for your time.